An urgent gathering on critical minerals has just been convened by the United States government. The meeting is set for this Wednesday, mere days after silver experienced a devastating 41% plummet, its most severe drop in 46 years. Now, I want you to consider this. Why would the planet's most influential government summon international delegations to discuss minerals in the very same week those minerals were annihilated in the markets? What crucial information do they possess that remains hidden from you? And here is the detail that truly struck me. While you were witnessing silver collapse from $121 down to $72, while your trading screens were flooded with red, while every news outlet declared the era of precious metals finished, an entity on the opposite side of the globe was actively purchasing that identical silver at a 29% premium. They were not selling in panic. They were calmly, methodically paying a higher price, even as Western markets entered a state of total freefall. By the conclusion of this presentation, you will be shown a chronological sequence that will fundamentally alter your perception of this entire event. You will discover the precise identity of the buyers who stepped in while everyone else was fleeing. Furthermore, you will be presented with 3 critical facts the mainstream financial press has entirely overlooked. These facts narrate a story starkly different from the one you've been told. Welcome to the hidden economy. This channel is dedicated to decoding the financial maneuvers that occur behind the curtain. Make sure to subscribe because the information we are delving into will not be found on CNBC or Bloomberg. If you find this analysis valuable, please press the like button. Now, let's begin. This narrative extends far beyond a simple market crash. To fully comprehend the situation, I must briefly set the stage because the events preceding the crash are essential context. I'll be concise as I know you're here for the deeper story. Silver skyrocketed from $30 in early 2025 to an astonishing $121 by late January 2026, a 300% surge in just 13 months. Gold reached a record peak of $5,595. This explosive rally was driven by unprecedented central bank acquisitions, global de-dollarization trends, and soaring industrial demand. However, in the final stretch, a shift occurred. Chinese speculators, retail investors, equity funds, and momentum-driven algorithms all flooded into the market simultaneously. In January alone, silver surged an additional 54%. Night after night, while America slept, aggressive buying from China pushed prices higher. Each morning, Western traders awoke to discover they had missed overnight moves of 3 to 5%. One market strategist labeled it the most volatile month in the history of precious metals. The market had abandoned fundamentals. It was operating purely on adrenaline. And there is a fundamental truth about adrenaline. Eventually, the body crashes. On Thursday, January 30th, 2 significant events coincided. President Trump nominated Kevin Warsh as the next Federal Reserve chair. Warsh is considered a policy hawk favoring higher interest rates and tighter monetary conditions, factors traditionally negative for precious metals. Concurrently, the US dollar began a pronounced strengthening trend. This combination acted as the pin that burst the speculative bubble. What followed next? I want you to visualize this, because unless you were stationed at a professional trading terminal, you cannot grasp the sheer velocity. Gold was trading at $5,590. 10 minutes later, it had plunged by $200. $200 per ounce vanished in roughly the time it takes to brew a pot of coffee. But gold was merely the tremor. Silver was the full-scale earthquake. The selling originated in Asian markets. Chinese investors, the very same cohort that had been propelling prices upward nightly for weeks, abruptly reversed course. They began taking profits. Once this selling commenced, it became self-perpetuating. Each downward tick triggered automatic margin calls. Each margin call forced another round of selling. Every wave of forced liquidation catalyzed the next wave. It was a cascading waterfall, a chain reaction beyond anyone's capacity to halt. One fund manager described watching his screen and feeling physically ill. Another veteran stated that after 20 years in commodities, he had never witnessed anything comparable. The speed was algorithmic, inhuman. Machines were selling to other machines. Human traders were rendered spectators. By the time the London market opened, the damage was already catastrophic. Friday, January 30th, silver plummeted 37% from $121 towards $75. This was the largest single-day crash since 1980, 46 years prior. Traders termed it a capitulation event. The sole word on the lips of every desk around the world was bloodbath. But here's the crucial point. Friday was not the ultimate bottom. The events that unfolded over the ensuing weekend exacerbated the situation dramatically because a decisive action was taken that essentially poured gasoline onto an already raging fire. Over that weekend, the CME Group escalated the margin requirements for silver futures from 11% to 15%. For those unfamiliar with futures trading, let me illustrate with a simple analogy. Imagine purchasing a house with a minimal down payment. Then, on a Saturday night, your bank calls demanding you double that deposit by Monday morning, or they will foreclose. You scramble but cannot secure the funds, and they seize the property. Now, envision this scenario impacting thousands of traders simultaneously. The result is forced liquidation, driving prices lower, which in turn triggers more margin calls, leading to more forced selling, a self-feeding death spiral. On Monday, silver dropped another 4%, hitting $72. The total devastation from 121 to 72 is a 41% collapse in under 72 hours. Gold found a bottom around $4,400, down 21%, marking its worst crash in over a decade. Every asset class was awash in red: equities, cryptocurrencies, commodities, everything. I need to pause here, because this is precisely where every other analysis of the silver crash concludes. They state it crashed, they explain the superficial reasons, they advise caution, and they move on. But this presentation is different because I am about to reveal 3 pieces of evidence that completely transform the narrative. 3 interconnected facts that no one else is assembling. The first one, when I uncovered it, genuinely caused a visceral reaction. I had to verify the data 3 separate times as I could scarcely believe it. While silver was in freefall, while every Western exchange was in full panic mode, while every headline shrieked meltdown, I examined the data from Shanghai. The spot price for silver on the Shanghai Gold Exchange was equivalent to 111.86 per ounce. Let me ensure that resonates. At the exact same moment, silver in Western markets was trading at $78. Silver in Shanghai was commanding 111.86. This represents a gap of 22.98 per ounce and a 2029.14% premium. The identical metal, the same chemical element from the periodic table, was carrying 2 radically different prices on opposite shores of the Pacific, and the side everyone assumed was in maximum panic. China was willingly paying 29% more for it. Why? Why would any rational actor pay a 29% premium for an asset they could theoretically acquire cheaper elsewhere? The answer lies in a compelling possibility. Perhaps the cheaper price is not real. Perhaps the paper price is deceptive, and the physical price is revealing the truth. Perhaps the Western market is pricing paper derivatives and futures contracts, while Shanghai is pricing tangible, physical metal. Contemplate that for a moment, but stay with me because the figures become even more astonishing. What I will show you next may be the most significant chart in the entire commodities complex at this moment. I analyzed the Shanghai premium chart over the preceding 12 months, not the price of silver itself, but the premium, the persistent gap between what Shanghai pays and what the West pays. That gap has expanded by 174% in a single year. I will state that figure once more for emphasis. 174% throughout. That is not indicative of a normal, functioning market. That is a market screaming that something is fundamentally fractured. Now here is the second revelation nobody is highlighting. This one is equally extraordinary. On the Shanghai Futures Exchange, SHFE, every single silver contract hit limit down. AG262, 20%, AG2603, 20%, AG2604, 20%. The entire forward curve was locked, frozen. Circuit breakers were triggered. Trading was halted, even for those who wanted to transact. But here's the detail that should make you pause. Convert those limit down prices into US dollars. The SHFE February contract at its limit down price was equivalent to $94.97. Western futures were trading at 78.8. China's crash price, their absolute worst-case scenario floor, was still 16 higher than the level at which the West was freely trading. Their floor is our ceiling. Read that again if necessary. China was not a passive observer. They intervened aggressively. 5 commodity funds were fully suspended from trading, not restricted, but suspended entirely. The UBS SDIC Silver Futures Fund was shut down for the second time in 12 days. 16 traders were barred from opening new positions or withdrawing capital for an entire month. Position limits were drastically reduced. They deployed every tool at their disposal to cool the speculative fervor. And yet, recall what I stated earlier. After all that, silver rebounded from $72 to $85. A floor was established. Remember this, as it will become critically important shortly. This leads to the question that occupied my thoughts last night. The Shanghai Exchange had begun tightening trading rules on January 27th, 3 days before the crash. They widened permissible price bands, raised margins, and reduced position limits. They were preparing. If they foresaw this event, who else anticipated it? This brings me to the third pivotal piece of evidence. I saved this for now, as you needed the full context first. JP Morgan, the largest bank in the United States and one of the most formidable forces in global precious metals trading, recently relocated its entire gold trading desk to Singapore. Not to a larger office in Manhattan or London, but to Singapore, positioned at the heart of Asia, precisely where physical demand is exploding, where central banks are accumulating, and where premiums sit 29% above Western prices. Consider this carefully. You do not relocate an entire trading operation across the globe on a mere whim. You do not move personnel, technology, and core infrastructure to the opposite side of the planet based on a single quarterly report. Such an action constitutes a multi-year, multi-million-dollar strategic repositioning. You execute it because your most astute analysts have scrutinized all available data and concluded that the center of gravity for precious metals has permanently shifted eastward. JP Morgan evaluated relentless Asian physical demand, 14 consecutive months of Chinese central bank gold purchases, supply chain disruptions, and Singapore's emergence as the new nexus for gold trading and tokenized assets. They made a deliberate decision. Position yourself where the market is destined to be, not where it has been. It is analogous to observing a billionaire discreetly selling a Manhattan penthouse to acquire farmland. You do not ignore that signal. You inquire, what crucial insight does he possess? Allow me to connect these disparate dots. Individually, each fact, the Shanghai premium, the limit down data, the fund suspensions, JP Morgan's relocation, is noteworthy. Collectively, they compose a story that changes everything. This is the segment where it all coalesces. Recall the emergency meeting I mentioned at the outset. This is where it becomes profoundly relevant. And honestly, this may be the most disquieting aspect of the entire episode. On Wednesday, February 4th, 2026, Secretary of State Marco Rubio is convening the inaugural Critical Minerals Ministerial at the Department of State in Washington, D.C. International delegations from across the world are flying in. The official statement declares the purpose is to advance collective efforts to strengthen and diversify critical mineral supply chains. For those fluent in bureaucratic language, strengthen and diversify translates to, we have a severe problem. We are dependent on supply chains we do not control. We must address this before it escalates into a national security crisis. Here is why silver holds more strategic weight in this context than perhaps any other mineral on their agenda. One statistic fundamentally reshaped my understanding when I encountered it. Silver is not merely a precious metal for trinkets or heirlooms. It is the indispensable backbone of the modern technological economy. Solar panels cannot be manufactured without it. Every electrical contact in an electric vehicle utilizes it. 5G infrastructure requires it. Semiconductors depend on it. Advanced military systems, from guided missiles to satellite communications, rely on it. Medical imaging equipment incorporates it. Your smartphone contains silver at this very moment. Now, here's the number that should alarm every policymaker in that room on Wednesday. The world consumed 680 million ounces of silver for industrial applications in 2025. This represents 60% of total annual silver demand, going into products that are consumed, used up, not stored in a vault. For years, the global market has operated under a supply deficit, consuming more silver than it mines. Annually, the only factor bridging this shortfall has been the drawdown of existing above-ground stockpiles. Those stockpiles are depleting. This deficit cannot be rapidly rectified. The majority of silver is not mined independently. It is extracted as a byproduct of copper and zinc mining. Very few primary silver mines exist globally. Bringing a new major mine online requires approximately a full decade. Therefore, even if silver prices soared to $500 tomorrow, significant new supply would not materialize until the mid-2030s. This is the structural trap that distinguishes silver from nearly every other traded commodity. Consider the potential outcomes from Wednesday's meeting: government stockpiling initiatives, where the U.S. begins acquiring and storing physical silver akin to the Strategic Petroleum Reserve. Implementation of export controls, similar to China's policies on rare earth elements, bilateral agreements with allied nations to secure long-term supply, tax incentives for domestic mining, restrictions on foreign acquisition of strategic silver reserves. These are not theoretical concepts. They are precisely the maneuvers governments enact when they identify a commodity as too strategically vital to be left to the whims of traders and speculators. China initiated this strategic play years ago, a fact most Western investors fail to grasp. They have enacted export controls on critical minerals. Their central bank has engaged in 14 consecutive months of official gold buying. They are building strategic reserves across multiple commodities. They have restricted rare earth, gallium, and germanium exports. They are methodically and systematically securing the physical resources upon which the modern economy is built. They are executing a 50-year strategy while Western financial markets remain fixated on 50-minute intervals. China is accumulating actual atoms, tangible metal, and physical supply, while the West trades paper promises on those same resources. It now appears the United States is belatedly awakening to this reality this Wednesday. I am keen to know your perspective. Share your thoughts in the comments immediately. Are we witnessing the opening moves of a resource war, or am I overinterpreting the signals? Let's revisit the timeline once more. I want you to internalize each entry, not just read it. Late January. Silver at 121, gold at 5,595. All-time highs, universal euphoria. Friday, January 30th. Silver crashes 37%, gold drops 9%. Market panic ensues. The weekend. CME raises margin requirements. The mechanism for forced liquidation is activated across all major exchanges. Monday, February 3rd. Silver hits $72, total destruction, 41% erased. On the SHFE, every silver contract is limit down. 5 funds are suspended, 16 traders are banned. Shanghai continues to pay a 29% premium. Tuesday and Wednesday. A shift occurs. Silver recovers to $85. Gold climbs back above $4,800. Buyers return. The floor holds firm. Wednesday, February 4th. The United States hosts an emergency critical minerals ministerial. Within this identical time frame, JP Morgan completes moving its gold desk to Singapore. Examine that sequence. Scrutinize every entry. You tell me if that appears coincidental. I've analyzed it for hours, and I cannot force it to seem random. Before I share my personal interpretation, let's incorporate a perspective that adds a crucial layer to our discussion. Pay close attention, as this reframes the entire crash. Ray Dalio, one of the world's most successful and respected investors, founder of the globe's largest hedge fund, recently offered a pertinent observation. He stated, "Something needs to prick the bubble to cause a market crash." Initially, one might assume the silver crash was that pinprick, but Dalio then said something profoundly arresting. Historically, what ended overvalued markets was something that led to sustained outflows of cash, rate hikes, quantitative tightening, month after month of cash being pulled out of the system. That is what kills bull markets. Not one event, not one crash, a sustained mechanism that drains liquidity. He further noted that currently, interest rates are still more likely to decrease than increase. Even with Warsh's nomination, the Federal Reserve remains on a path to conclude quantitative tightening. The market, he argues, is merely adjusting for a slightly less dovish Fed. Dalio's exact words were, "The pricking we need to trigger a crash is still not here." Reflect on the implication. Imagine driving at 100 miles per hour. Someone lightly taps the brake, slowing you to 95. That is what the Warsh nomination represented, a tap on the brake. Silver reacted as if the vehicle had been driven off a cliff. This colossal discrepancy between the size of the trigger and the magnitude of the reaction is profoundly revealing. It was not the foundational thesis that shattered. It was the speculators, the excessive leverage, the algorithmic froth, the weak hands that were violently obliterated. The fundamental case for precious metals did not alter, not even slightly. Recall the 1970s, a historical parallel essential for understanding the present moment. Gold surged from $40 to $200. Euphoria was pervasive. Then it crashed by 50%. Headlines published obituaries for the bull market. Analysts proclaimed it was finished. Everyday investors who had allocated savings to gold panicked and sold at the bottom. They absorbed the loss, moved on, and forgot about gold. Subsequently, gold ascended to $800 from $200 to $800. Those who sold during the shakeout missed a 400% advance, one of the single greatest wealth creation events in modern financial history. The crash did not terminate the bull market. It eliminated the tourists, the speculators, the weak hands. The underlying structural trend proceeded without them. Those who comprehended the fundamental reasons for gold's ascent, who were not merely chasing momentum, held their positions and were rewarded beyond all expectation. Now, observe the current landscape. Silver ascended from $30 to $121. It crashed 41% to $72 and is now trading at $85. Gold declined from $5,595 to $4,400 and has since recovered to above $4,800. Both metals have rebounded. Both have discovered a floor. This is not the behavior of moribund assets. Let me be precise about why the recovery is significant. Silver's bounce from $70 to $85 constitutes an 18% rally from its lows in just 2 days. Gold recovered from $4,400 to above $4,800. Consider what this communicates. When a genuine bubble bursts, when an asset class is in terminal decline, you do not witness an 18% rebound with conviction. You typically see a feeble, short-lived bounce followed by a slow, grinding descent over months or years. Dot-com stocks did not bounce 18% after the 2000 crash and hold those gains. They bled for 2 years. Silver and gold bounced, and they held. Authentic buyers were waiting at those depressed levels. They assessed the structural supply deficit, they considered the 680 million ounces of annual industrial consumption, and they concluded, this is excessively cheap, we are buying. That is not hopeful sentiment. It is a tangible market signal. The recovery was neither random nor a mere dead cat bounce. There is a concrete reason silver established a floor at $72 and not at $50, $40, or zero. Solar panel manufacturers cannot cease purchasing silver. It is not optional. Without silver paste, production lines halt. Crucially, silver paste constitutes only 3–5% of a solar panel's total cost. Even if silver reached $150, the impact on the final product's cost would be marginal. But without silver, there is no panel, no product, no revenue. This demand is profoundly inelastic. It is indifferent to margin calls, algorithms, or panic selling. It buys silver because the alternative is complete factory shutdowns. This extends beyond solar. Reports indicate corporations are increasingly securing physical supply through direct off-exchange deals with mining companies. When industrial consumers bypass transparent exchanges to contract directly at the source, they are sending a powerful message about supply security that no futures chart can convey. They are signaling a lack of trust in the exchange's ability to guarantee delivery. This is why the floor held. This is the origin of the buying at $72. A complete analysis requires acknowledging the genuine risks. This was undoubtedly a speculative mania. Prices advanced too rapidly. A correction was inevitable and, from a long-term health perspective, necessary. Marko Kolanovic, formerly J.P. Morgan's chief strategist, has warned silver could retreat to $50 as excesses unwind, a plausible scenario. A persistently strong U.S. dollar could continue to pressure metals for weeks or months. A slowdown in global economic growth could soften industrial demand. These are legitimate concerns. Any commentator suggesting silver's path is only upward is being disingenuous or is promoting an agenda. This is not financial advice. Conduct your own thorough research. Consult with a qualified professional. Never risk capital you cannot afford to lose. Here is what I'm monitoring this week, and what you should observe as well. The outcomes of Wednesday's minerals meeting are paramount. Should the proceedings produce any official language concerning government stockpiling programs, announce new bilateral supply agreements, or specifically designate silver as a strategic resource, the entire investment calculus shifts. Government procurement is not speculative demand. It does not panic sell on a Friday. It accumulates systematically over years and decades. Scrutinize the official statement released after the meeting, watch for any subsequent executive orders in the following days, and continue tracking the Shanghai premium. If it remains elevated above 20%, even as Western prices stabilize or recover, it will be a potent indicator that the physical market is broadcasting a message the paper market has yet to fully comprehend. I will be covering all developments on this channel. Before I conclude with my personal synthesis, I want you to ponder 4 questions. I have attempted to argue against their implications from a bearish standpoint for days, and I cannot formulate satisfactory answers. 1. If this was merely a bursting bubble, why is Shanghai persistently paying a 29% premium for physical silver? 2. If demand truly collapsed, why did Chinese authorities suspend funds to curb excessive buying, not excessive selling? 3. If silver is inconsequential, why did America's largest bank relocate its core precious metals trading desk to Asia? 4. If none of this holds importance, why is the U.S. government convening an emergency critical minerals summit this Wednesday? The mainstream financial media has not adequately addressed a single one of these queries. Therefore, I will offer my perspective, not as a financial advisor, but as an individual who has spent days immersed in these charts, regulatory filings, and data sets, losing sleep over their implications. I believe we have just witnessed a historic event, and I am not referring solely to the crash. Market crashes, while painful, are periodic features of finance. What is extraordinary is what this crash exposed beneath the surface. I posit that Friday, January 30th, 2026, may be remembered as the day the paper silver market and the physical silver market formally divorced. They were once loosely coupled, generally moving in tandem. That relationship is now severed. We observed 2 entirely distinct markets masquerading as one. The Western paper market, driven by leverage, algorithms, and margin mechanics, crashed 41%. The physical market, comprising the actual metal required by industry, hoarded by governments, and stockpiled for strategic purposes, barely flinched. Shanghai maintained valuations over $100, while New York was liquidating at $72. This is not a typical divergence. It is a fundamental decoupling. I do not anticipate a reconciliation in the near future. This leads to a profoundly personal and unsettling realization. Wealth does not vaporize in a crash. It is transferred. It moves from one set of hands to another, from those who react to headlines to those who analyze data, from those who panic at red screens to those who have meticulously prepared for this precise moment. Rewind to Friday morning. Your screen is red. Every indicator is negative. Your instinct screams to sell everything. At that exact instant, a counterparty in Shanghai was paying $111 for the same silver you were preparing to dump at $78. They observed a 41% collapse and declared, "We will accept that delivery." At a 29% premium, this was not retail investor activity. This was sovereign strategic capital, the kind of capital that plans in decades, not days. That is a monumental transfer of wealth. It occurs during every crisis, every panic. This is the fundamental reason I create this content. My objective is not to dictate buy or sell decisions. My purpose is to combat the single greatest disadvantage faced by ordinary investors. Not a lack of capital or access, but a lack of context. The ability to zoom out when every instinct and external signal compels you to zoom in. The Shanghai premium, the SHFE floor price, the JP Morgan relocation, the emergency government summit, none of this contextual information was displayed on your trading screen last Friday, yet collectively it matters infinitely more than the red candlestick that dominated your view. Therefore, when people ask me, is silver dead? I believe they are posing the incorrect question. The pertinent question is, which silver? The paper silver traded on your brokerage app, that market may indeed be broken. It just demonstrated its fragility. But the physical silver that China is accumulating, that JP Morgan relocated to be proximate to, that governments are holding emergency meetings to secure, that solar panels, missiles, and semiconductors physically cannot function without, that silver has never been more critically alive. The fact that these two silvers now command completely different prices may represent the most significant development in the commodities space in my lifetime. That is my candid assessment. I could be entirely mistaken. However, I have examined the data from every conceivable angle, and I consistently arrive at the same conclusion. This also provides the answer to the question I posed at the very beginning. Who was buying at $72 while everyone else panicked? Now you know. And now you understand why the crash was authentic, the pain was real, but a 1,874% expansion in the premium over 12 months. Clearly indicates the trajectory of this story. The proceedings in that Washington meeting room on Wednesday may well determine the velocity at which we travel that path. Share your perspective in the comments. Is this the conclusion for silver or the foundation for something vastly more significant? I read every comment. The most incisive analysis on this channel often originates from you. If this connected dots you hadn't previously seen, please share it with one person who needs this perspective. If you are not yet subscribed, I encourage you to do so. This is the hidden economy. I will see you in the next video.